welcome to Reinsurance Point of View review series. Today we have Jeremy Trader. He is the Chief Actuary of Knighthead Annuity and Life. Hi Jeremy, given the rapid rise of interest rates in recent years, some insurers have seen substantial unrealized loss in their balance sheet. So how does reinsurance pricing taking this into consideration, and specifically, does that mean the insurers are disadvantaged in this kind of situation?
Yeah, thank you for asking me to participate in the review series. Certainly a topical question, one to which we've seen obviously a lot of activity in the block pricing market. We've certainly been busy on our end for it. Unfortunately, as with most things, there is no definitive answer. Rather, there's a number of variables that need to be taken into consideration that really affect both the asset and liability cash flows. The cash flows will drive the pricing metrics for the reinsurer, so it's really about understanding how these unrealized losses do factor into the reinsurer pricing cash flows and ultimately the ceding allowance. We like to think of this as a sort of pricing spectrum. On one end of the spectrum, we have the most intuitive or simplest to understand, which is just a cash deal. The primary difference would be whether the mark-to-market loss is borne by the cedent or the reinsurer. In either case, it results in a negative time zero cash flow equal to the mark-to-market loss on those assets. In the first scenario, the cedent would sell the asset portfolio and pass assets in cash to the reinsurer equal to the stat reserve, in which case the reinsurer is able to deploy the full value of those assets over the lifetime of the contract, resulting in higher investment income at current new money rates. But obviously that has to at least partially offset the mark-to-market loss incurred by the cedent. In the second scenario there, the cedent will sell the entire assets to the reinsurer, and the reinsurer will have to bear the responsibility of realizing that time zero loss, resulting in a higher capital strain and a lower cede ultimately. On the other end of the spectrum then, you have a scenario where there are no assets sold, obviously then no mark-to-market loss is realized, and the entire portfolio just runs off organically. In that scenario, however, the investment income earned by the reinsurer is at the lower book yield, resulting in a lower ceding allowance. In reality, we often find ourselves somewhere in the middle, which is the reinsurer will take a look into and review of the asset portfolio and sell or keep a portion of those assets. And so now we have, along that spectrum, a series of pricing points where we've priced to be relatively indifferent from a profitability or pricing metric standpoint. We in turn offer the highest ceding allowance to the carrier to maximize their benefit and the overall competitiveness of our bid. So in keeping with the view of pricing as a spectrum, there are then layers down or levels of refinement to that pricing and different variables that you would want to consider associated with that. So first and foremost, probably asset liability management. So that can be a function of potentially cash flow mismatches. So for example, the assets are longer in nature than the liability cash flows, in which case the reinsurer in that scenario has to realize that mark-to-market loss, and then the investment income earned on those assets is no longer there to support future cash flows. In the first scenario that we looked at along that spectrum, we assumed that there were no forced sales driven by the liability cash flows, and so we've introduced those now. The other scenario that might arise is differences in opinion between the underlying assumptions on the liabilities between the carrier and the reinsurer, in which case, for example, shock lapse may be an easy example to understand, where if the reinsurer price is assuming a higher shock lapse, that will bring the liability cash flows forward and potentially exacerbate the former problem. The next and less common but important is any asset impairments. To the extent that the potential cedent and the reinsurer have differences of opinion on the mark-to-market value of those assets, the reinsurer's pricing may dictate a haircut in that. Noteworthy and important, we typically try to structure an agreement such that we can bridge the gap between the carrier's view and the reinsurer's view and not let that stop something getting done. Easy examples to those are you could structure the ceding allowance to be either a trail commission as opposed to all up front, or some form of an experience refund, where to the extent that those assets are marked to market properly, or the liability cash flows and shock lapse assumptions are better than expected, the ceding company will receive a ceding allowance as that experience emerges favorably. And finally, the last one I'll touch on is the interest maintenance reserve, or IMR balance, that may be associated with the block. And that really is driven primarily by whether the ceding company will transfer the stat liability, so net of IMR, or stat reserve and the assets supporting that. And then to which base does the reinsurer top up to. And so in conclusion, you can see that the question of whether or not the ceding company is impacted negatively by the negative mark-to-market losses is really dependent on a in-depth analysis of the asset and liability cash flows.